Hello and welcome again to Christopher Shaw. My name is Matt and this is my colleague James. And we've got another financial guest on today. This kind of finishes off the financial sector of our post. And today we're going to be welcoming a very special guest. This is Shelley Powell, who is an independent mortgage advisor. Welcome, Shelley. Thank you for joining us.
Yeah, thanks for having me.
Nice to see you. Nice to see you. We've also been talking a little bit off camera. It's going to be a very interesting one, I think, today. So we hope our guests stay online right to the bitter end and pick up some good information from this. We're going to be looking to get a bit of insight into the buy-to-let mortgage market. So starting off, what can you tell us is going on right now?
Okay, well, firstly, I think just, we can't really get away without referencing the past year and how that's negatively impacted lending. I think at the beginning of the pandemic, lenders expected there to be dramatic house price drops. And in fact, one of the key lenders' chief executives was quoted in the press as predicting a 13% drop in house prices. And so, as you can imagine, then that sort of affected the appetite for lending at the higher LTVs. So for residential lending, it was difficult to get a mortgage above 85% loan to value. And for buy-to-let lending, really you needed to be looking at a 35, perhaps 25% deposit. And on top of that, lenders tightened up their criteria quite significantly. They tightened up their scorecards. And so we're really lending to what they consider to be prime buyers on quite a stringent criteria. But what we've seen and what you've no doubt seen as estate agents is absolutely unprecedented demand in the housing market, which has been really surprising given the situation that we've been in. And we've also had stimulus with the government with the stamp duty sort of popping up, and we've seen some changes in behaviours with people wanting to move out into more rural areas, bigger areas, combined with a lack of stock as well, unfortunately, for brokers and estate agents as well. And that's pushed up house prices. I think figures out on the nationwide house price index just been released. So slightly down on August, but 10% year on year. So off of the back of that, of course, we've seen some really increased confidence from lenders that we're not going to see the catastrophe that was initially forecast. And we've now seen higher LTV products pretty much back to pre-pandemic levels. So for residential lending, we're looking at accessibility to 5% deposits. And for buy-to-let lending, mainstream lenders now are back to offering 80%. And where it's really difficult previously for people who are self-employed to get a mortgage, much more difficult, it had to jump through many more hoops, lenders now are relaxing their criteria. And we're seeing some really competitive pricing and competition amongst lenders, which is great for investors because that gap between residential rates and buy-to-let rates, which used to be quite significant, is virtually meeting non-existent. So borrowing has never been cheaper, and the competition amongst lenders is great for investors really looking forward.
It kind of says again how robust the UK property market is. I think in particular, in our areas in the South Coast, tends to survive many storms.
Yeah. So I think London probably taken the highest hit really, but for investors in this area, or perhaps looking more region, we've seen sort of interest in Cardiff and traditional cities where they've been higher yielding. But a really buoyant market, and it's not just people who are looking to purchase who can benefit from those low rates. Of course, it's those existing investors as well coming towards an end of a deal, looking to remortgage now onto some really good rates, longer term fixed rates, 5-year fixed rates have never been lower.
That's great. So before we came on, we were talking about sort of what factors can affect borrowing, and in particular changes to EPC legislation and how that might affect particularly landlords going forward.
Yeah, well, as you're aware, or you may be aware, there is a minimum EPC requirement of E. And so lenders pretty much are falling in line with that. They're not going to lend on a security unless the property is compliant with those regulations. And we've seen in the market many mortgage applications going in where a simple check on the EPC register would have made it a much less onerous mortgage application process. So lenders will check the EPC register and make sure the property is compliant, and if it isn't, they will decline an application. And sometimes it's easily rectified, and I guess you may be able to offer your landlord some advice around that. It can be as simple as a change to more energy efficient light bulbs to make the change, but otherwise but otherwise it could be more significant changes, boilers, windows and so on, to improve the rating. But I think more significantly as well, lenders, the green agenda is very important at the moment, and lenders are taking that very seriously, and looking ahead. The regulation is that for, and correct me if I'm wrong, I think for new tenancies by 2025, the EPC is expected to be C. And for existing tenancies, they've got until 2028. So not long at all for landlords really to be thinking about making that changes, not only to be compliant, but also in order to access the full range of mortgage lending that could be available to them.
It's also the definition of the renewal tenancy and existing tenancy, in that some legislation reflects having a new EPC at the new rating for a renewal. So even though it's the same tenant in the same property, sometimes it's that. So again, from a mortgage perspective, I guess it's the same as well.
So, we've seen people who have been fortunate enough to rent to the same tenant for many years. And the status quo has been just as it is, but of course they haven't even realised that change has been applied until perhaps they've come to refinance, if they don't use a letting agency. So it is quite an important factor in mortgage lending that the regulations are adhered to.
So what tend to be the best banks for buy to let? Is it the traditional big high street banks, or are there other lenders that are
it's an interesting question, because the best bank, generally people would think who's got the appetite for lending and who's offering the cheapest rate. But buy-to-let lending has become much more complex now, with portfolio landlords, with lenders having to consider somebody's whole portfolio. And so then you get lenders who will offer lending to those people who have only got 4 properties or 10 properties or unlimited properties. You could have somebody who's getting a bit older. They don't want to sell the property at the end of a mortgage term. So they're the lenders that will offer non-existent terms. So it doesn't matter how old an applicant is. So price plays a part of it. But because buy-to-let lending is so complex, there are so many other considerations that a good broker will take into account and match that best price possible to a client's circumstances. So you've got your mainstream buy-to-let lenders. The largest buy-to-let lenders is the Mortgage Works at the moment, and next under Lloyds Banking Group is BM Solutions. So these are mainstream lenders that offer some really competitive rates, limited company products, HMOs. BM we've seen come back into that space, but also their inbuilt criteria is just as important as the rate. So for example, the Mortgage Works have no limit to the number of properties. They can lend someone up to 5 million, and they don't care how old you are. So if you're looking at an investment property as a long-term retirement proposition, then that could be a really good lender for you. And then you have the other lenders who can't compete as competitively on price. So you've got the high street lenders. So you've got BM Solutions, the Mortgage Works, your Barclays, who can compete in that arena of price. But then you've got the other smaller niche lenders who can't compete on price, but they can look at more unique circumstances. Expats, maybe if you've had some payment difficulties over the last 12 months, that they will, as long as your situation is back on an even keel now, they won't penalise you for that. So as to who the best lender is, I've got to say it really depends on somebody's circumstances, what they're looking at. But there are some, I'll go into more detail on products and some of the benefits to be had, shortly. I think you wanted to get to that a bit later.
Yeah. Well, what about tips for remortgaging? So obviously people have typically remortgage after a fixed term or what have you. From a buy-to-let point of view, what about tips for remortgaging? What are the best things to...
Well, what I would say in terms of remortgaging is that it's really important that you do consider the whole of market when you do come to the end of your deal with your current lender. I think many people, can't be bothered, and it's just easier to log in or just switch. Yeah, I think we're all guilty of that. But if I can just, we can look at it another way. We've had lenders' margins have been really hit over the last 12 months. So not only have we got very low interest rates, which is obviously what lenders can make their profits on, we've also, lenders have been hit by payment holidays, hundreds of thousands of mortgage deferrals. So one way that they could enhance their bottom line is by looking at their existing customers. And we've all heard about utility companies offering, and phone companies offering preferential rates to new customers. And it's really annoying if you're a customer who's actually been loyal to that provider. And unfortunately, it's no different with some mortgage lenders. So to put that into context, what I'm trying to illustrate is the benefit in not switching and having a look at the whole of market. So I looked at one of the key lenders' rates, their new business rate, and then the equivalent product for a follow-on rate, so a switch rate. In this example, I was looking at £150,000 mortgage, 75% loan-to-value product, and there was a fee attached to the product for each, the follow-on and also the new business of £995. So the difference in rates then is just for a 5-year fixed. For new business was 1.84% for a 5-year fixed buy-to-let. The follow-on rate was 2.89. So 2.89 doesn't sound like a bad deal actually, but on a £150,000 mortgage over a 5-year period, you've got a differential of £7,800.
Wow, that's massive.
On a £200,000 mortgage, you've got a differential of £10,500 with that rate difference. So I'm just really emphasising how important it is to have a look at the whole market, even if your circumstances have changed, because there's, if you've gone from employed to retired, there's usually still a lender that can help and offer you a much better deal than the follow-on rate.
That's some really good advice. We're going to put you on the spot here now. We obviously mentioned about some rates and deals. Obviously, what we'll hopefully do, this is going to be in an email format for some of our clients. We'll follow up with maybe some graphs or bullet points. But for those watching on the video, is there any kind of current deals or best rates which stand out above others at the moment?
Yeah, I mean, you've got the big hitters like the Mortgage Works, Barclays, HSBC who did withdraw their buy-to-let position, have just come back into that market yesterday to all intermediaries. So obviously the deals that you get are going to affect on the amount of equity or the deposit that you have in your property. But the market leading rates are usually going to be from the Mortgage Works, BM Solutions, and there's so little margin in between these rates, so it's ultimately going to come down to a policy point that's going to win, that's going to dictate where that business goes to. So as I've already said, you're looking at 5-year deals now, floating around 1.77%. Barclays, TMW 1.84 for a 5-year fixed, 75% loan to value. But rates for a 2-year fixed, I think the market leading one was 1.14 at 75% loan to value. So if you think about historic buy-to-let rates, and these are for standard products, because the limited company is another topic, but if you think about the historic average for buy-to-let rates being sort of in the 4 or 5s, you see now what a good time it is to perhaps consider locking onto a longer term deal. And of course, with base rates being 0.1%, there's probably only one way they're going to go over the next few years, especially with inflation sort of looking like it's on the up. And other factors, of course, in terms of tips. So we've discussed rate, but a lender will typically use a scorecard to decide whether you're a good bet to lend to. So you've got other aspects that are going to come into it, like debt to income ratios. how much of your credit card balances you'd use up. But it's the sort of thing a broker can talk through with you and advise you on the best lender to match your circumstances as well.
Well, thank you very much, Shelley. It's been really good to talk to you and hear about some of these things today. The stuff about the EPC is to be that far ahead. The lenders thinking that far. Of course, they've got to do that to protect what they're lending on. But that's a real important point, I think, for a lot of landlords to consider now. And that is my big takeaway, I think, from this one today.
100%. Yeah, I mean, we're going to be talking quite a lot about EPC improvements and regulations, but to know it has an impact on future lending and borrowing is just hammers it home even more for us. And it's the time to start on making these changes is now, so you're not caught on the hop later.
Indeed.
Yeah, I will say as well, just one final point on the EPC, as it is of particular interest to you. So if you have got a landlord who's not in a position yet, who's still locked into a deal and isn't in a position to refinance at this time, lenders, I mean, as I said, the green agenda is very important at the moment. And so they're offering to their existing borrowers preferential green further advance rates, which are much lower again. So that will enable them to just take some money out of the property and borrow at really dirt cheap prices in order to fund a new boiler. It's something that falls under the green definition.
That's really good. Yeah, that's a good tip. That's a good tip.
Well, we'll put your details below so people can get in touch with you. But thank you very much indeed again. I really appreciate it. We'll hopefully catch up again soon.
Thank you. Thanks, guys.
Bye-bye. Bye-bye.